Hello. Today I would like to discuss another important concept of the stock markets, and that is options and futures. And these concepts are by some people seen as different, as difficult, but I'll show you that are actually quite simple concepts and that are easy to understand. So that's the target of today. These options and futures are also called derivatives. So you're also going to get some insight in what's going on with the current credit crisis. So let's go into them. Let's talk about what they are and what they can do. So I'm going to make a simple scenario just to explain that. Let's, for example, I sell apples and other types of fruit, and you would like to buy an apple for me. Yay, apple. But you do not want to buy an apple now. You want to buy an apple in, let's say, 3 months. Not this apple then, but just an apple. And so we agree that you are going to buy an apple for me in 3 months, and we already agree a price. So we agree, for example, that in 3 months' time from now, you will buy an apple from me for, let's say, $1. And after these 3 months, you will buy that apple for me. And for example, if the price of the apple has gone up in these 3 months, you've made a profit, because you can then buy an apple for me for $1 and then sell it on the market, for example, for $1.50. But if the price goes down, you've made a loss. If the price is, for example, 50 cents, you can buy an apple for me for $1 and then you should sell it for 50 cents on the market, so that would be a bad deal. And what happens with options is that you can always decide as buyer of an option, buyer of that contract, you can also decide whether you want to buy that apple or not. So if the price goes down, you just decide, well, I'm not going to buy that apple, sell it to someone else. So that's actually quite beneficial for the buyer of that option. Because, well, if the price goes up, you just buy the apple and then sell it for a profit. And if the price goes down, you just don't buy the apple and buy apples elsewhere. So the question is, what do I, as seller of the apple, get for that? Well, what do I get? I get a tiny fee. And that's actually the price of the option. The price of the contract I'm making with you. You pay me an amount of money, for example 10 cents, just to make that contract. And whatever happens to the price of the apple, I'm going to get that 10 cents. So if the price goes up, I'm going to sell my apple to you, and already have received 10 cents from you, so I've made a nice profit. And if the price goes down, well, I'll sell the apple to someone else, but I'll still receive the 10 cents. That's actually the deal of an option. And it also works that way with a future. The only difference with a future is that in the future forces you to buy or sell the product. So you're forced to buy that apple for me. So that's actually what an option is. An option is just a right to buy or sell a certain product at some time to someone for some price. Sounds difficult, but it actually is quite simple. I can just sell in 3 months this apple to you for $1. So you've got two types of options actually. One type that you can sell stuff with, and another type that you can buy stuff with. And most of the time, if you speak about options or general derivatives, that goes about options for stocks. And so you can sell or buy stocks from me in a specific amount of time. And options always go into a contract, and a contract consists of 100 options. So if you buy one option contract, you're going to buy or sell 100 shares of, for example, Apple or Microsoft for me in 3 months' time, for example. That's actually what options are. And the options to buy something are called call options, and the options to sell something are called put options. So that's actually what options are. In another video, we'll go further into them. But this is the basic principle, and this is the basic principle of derivatives. Just being able to sell or buy things in a specific amount of time. Thank you for watching. I hope you've enjoyed it.